Get your free copy of the complete tutorial at www.teachucomp.com/free. There are two types of accounting methods. They are accrual and cash. Accrual basis accounting means that companies record transactions in the period in which the events occur, even if no cash was exchanged. In this system, companies record revenues when earned and recognize expenses when incurred. Cash basis accounting means that the company records revenue only when the actual cash is received. The cash basis is not compliant with GAAP, but a small business that does not have a broad base of shareholders or creditors does not necessarily need to comply with GAAP. So the accrual method is typically used for large corporations, while sometimes the cash method is used in smaller businesses that do not have to comply with GAAP. Let's look at an example to get a better understanding of both methods. In this example, our company has purchased supplies in order to complete a paint job. Since the job started in December and was not completed until February, we were not paid until 2013. The accrual method requires us to record the expense and revenue from the job in the year the expenses were incurred. In the cash method, we record receiving payment when the company physically receives payment. So while both methods display the same numbers, it's important to understand the effects of recording economic events at different times on financial statements. This will not only affect the financial statements, but also the financial statements used for tax purposes. Different methods can change the appearance of the events. The cash method tends to be more misleading than the actual accrual method when analyzing financial statements. Also, it's important to note that once a company chooses a method of accounting, they must stick with it throughout the year. They may also need to get approval from the IRS to change the method later on. Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.